Welcome back. The battle over leadership at Gildan Activewear seems a long way from over, and several different outcomes seem possible. The company says it's considering a takeover proposal, but some large shareholders strongly oppose that idea and want the company to hold a shareholder meeting right away, months before the May 28th meeting currently on the company's calendar. At the core of the dispute is who should be in the chief executive officer's office. Joining me now is Grant White. He's a portfolio manager and investment advisor at IA Private Wealth. We're going to talk about this story and this stock and several others as well. Grant, thanks a lot for joining us. I think a lot of investors out there would look at this share price, which has been damaged by the turmoil, and wonder, is this an opportunity staring me in the face? Should I get in now, waiting for an eventual bump up, regardless of how this thing is settled? What do you think? I think your view is you're staying out of this for now.
Yeah, I mean, I don't like drama, and and this stock, this company is surrounded by drama right now. That's the reality of it, Paul. I mean, there was drama obviously for the last little while, going back to January when the CEO was ousted, and obviously we've seen drama ever since. And so, I have a tough time with this because there's really no direction on where it's going to go. Now, I do think that if they do go through this process of going to market and seeing what they can get, this could be a real win for investors, for shareholders. I mean, if you look at the pricing that is kind of expected in that process, and you get north of $50 or so a share, then things start to look quite appealing on it. But at the same time, it's anybody's guess on how this is going to go, especially when you get activist investors involved and what that's going to look like over the next little while. And so for those reasons, we're staying away from it, but it's definitely going to be a story to watch in the next little while.
You like the business, and I think most investors and most portfolio managers do. It's been very successful, at least until very recently, at what it does, which is make T-shirts and other apparel. Is probably still successful there. What we now have are management and governance concerns.
Yeah, I mean, I think that the reality of it is this, like if you poll the viewers, I mean, everybody has probably 2, 3, 4 Gildan T-shirts in their closet somewhere, and so we love the business because it normally stayed behind the scenes. It was a very quiet business that just kind of made money and did well, and more recently, obviously we're seeing that those governance issues that are just causing too many concerns for us to really get behind it and understand where we're going to make money easily on this one, and from that perspective, we just, we try to avoid those things when there's uncertainty around it, and rather not get speculative about what's going to happen in the next few months. Because, like I said, I think it's anybody's game as to how that's going to play out, and we'd prefer to sit on the sidelines and wait it out. If we were shareholders, which we're not, we'd probably hang on to it. But at the same point, we're not shareholders right now, so we're not looking to buy in. You once were shareholders of Gamestop. We've just showed our viewers that stock down nearly 15% today. It seems to be trading on earnings reaction these days rather than what people are saying about it on Reddit discussion boards, a phenomenon that it's still somewhat famous for. There's the stock down close to 15%. What are your thoughts on this? Would you go near this one at all? The short answer is no, Paul. I mean, we were shareholders some time ago, and actually we benefited from the meme stock, event, phenomena that happened there. We were shareholders before that, and frankly, we consider ourselves quite lucky that we were able to take advantage of that and get out at the time. I mean, I think we saw increases of 100% share price in a day or so, and we profited on that for our clients and for ourselves. So in saying that, it's not something that we've been invested in for a while now. Frankly, we just don't like the business model. We did before. We love the trend of gaming and firmly believe that, that is the way of entertainment going forward, or a big part of entertainment going forward. But admittedly, we likely got that wrong in terms of which company we backed. We were lucky and then we profited. But looking at it today, I just don't like the strategy of the company. I mean, you're looking at their software sales down 30% or so. Year over year, and there's no reason why their software sales, for example, are going to change. I mean, everybody's buying everything online now. They're just doing digital purchases. I'm not sure why people would start going back into a retail store to start buying their games, or even their consoles for that matter. And so from that perspective, we just don't really love the business model, and we're not sure that management can turn that around easily. Okay, what are your thoughts on the domestic stock market, the S&P TSX Composite Index? It has
It has finally started to outperform, not relative to the U.S. markets, but it's back in record high territory. Not quite there today, but certainly within shooting distance of record high territory. And it's posted a gain in the first quarter of this year of 5% already. What are your thoughts on the TSX? Are there opportunities there for investors?
Yeah, I mean, I think the TSX is actually very similar to a lot of other developed markets around the world right now. Is there, we're approaching this record high territory, no different than what we're seeing in the U.S. or some other markets. But at the same time, it's largely been led by, by the bigger companies out there, and in particular, looking at this year, we're seeing energy companies do well. Financials are not bad, but I think if you're going to try to outperform going forward, where you're going to have to look is in a diversified approach to maybe some smaller companies that aren't necessarily been the driving force over the last 12 months. And I'd say this about the US as well. I think what you want to, there are opportunities out there, but you're going to have to look outside of the regular traditional names. I mean, financials, I don't see that there's a huge boom coming there. I think they're going to be good holdings, don't get me wrong, but I don't see that you're going to see a 10, 20% boom there. And so I think if you're looking for the bigger growth opportunities, taking a diversified approach at small and mid caps is going to be a better idea, a better way to go. Okay,
so in that vein, a lesser known stock that would fit small cap status is Seabridge Gold, and it's a stock you like, ticker symbol SEA on the Toronto Stock Exchange. Tell us why you like Seabridge, and we'll finish there.
Yeah, I mean, I think actually, Seabridge and other companies in that vein are poised to do well. I would say arguably that, I would rather take a diversified approach versus just one holding. And especially as an investor, I think that you would be wise to take a diversified approach just because you're going to see more volatility in that space. But in saying that, I think that's where the opportunities are going to lie in the TSX. But truth be told, I think there's more opportunities in the U.S. market as it is anyway. And so, we're allocating more of our weightings south of the border still versus the TSX.